Most people see a recession as the worst time to invest. Markets fall, news headlines scream crash, and suddenly everyone rushes to pull their money out, waiting for the right moment to come back in. But that moment never really comes, because the truth is, the biggest wealth transfers don't happen after recessions, they happen during them. While most people panic and freeze, the smartest investors quietly reposition, buying the right assets when fear is highest. And that's exactly what we're breaking down in this video: how to protect your money, avoid the traps, and spot the rare opportunities that only appear when the economy turns red. Because a recession isn't just an economic event, it's an emotional one. When you see your investments drop by 40%, your brain screams, "Get out before it gets worse!" But that instinct, the one that feels protective, is often the exact reason most investors lose money during recessions. Let's break that down for a second, because what happens next is what separates panic from opportunity. If you sell in a panic, you lock in the losses. You turn temporary drops into permanent damage. But if you stay invested in the right assets, history shows that recoveries often erase those losses faster than most people expect. The market doesn't reward fear, it rewards patience and preparation. So the goal isn't to avoid the storm, it's to build a boat that can handle it. And that boat starts with one simple principle: protect first, then grow. During a recession, cash is both your safety net and your secret weapon. It's what keeps you from selling good investments at the worst time and what gives you flexibility to buy when others can't. But here's where many people go wrong. They hold too much cash. They think safety means sitting everything out. And that's where inflation quietly eats away at their wealth, month after month, while opportunities pass them by. So, how do you balance it? Here's where it gets interesting, because this is where most people get it wrong. Think of your cash like oxygen on a dive. You don't want to run out, but you also don't want to spend your whole trip clinging to the surface. The sweet spot is having enough to cover emergencies, living expenses, and short-term goals, usually 3 to 6 months worth, while the rest keeps working for you in smart, resilient investments. And not all cash has to sit idle. High-yield savings accounts and short-term treasury bills can earn you interest while keeping your money accessible. These aren't exciting moves, but they buy you time and stability, which are priceless when markets get unpredictable. Because here's what most people forget. Every dollar you protect now is a dollar you can later use to buy discounted assets when panic peaks. And if you want to see exactly how to turn that idea into action, I put together a free 5-step guide for you. You could download it right now through the link in the description or at griffinwise.com. So we've covered defense. Now let's move to offense. This next part is where the real strategy starts: how to actually invest during a recession without losing your mind or your money. Because while everyone's talking about when to get back in, smart investors are already building positions in the background, using a structure that automatically lowers risk the deeper prices fall. And once you understand that setup, you'll see why the investors who stay calm in recessions aren't lucky. They're just prepared. It's a method that's been used by professionals for decades, and yet most retail investors completely overlook it because it feels too simple. Here's how it works. Instead of trying to guess when the market will hit the bottom, which nobody can do, you spread your investments out over time. You keep investing small amounts on a regular schedule, whether prices are rising, falling, or staying flat. When the market drops, those same dollars buy you more shares. When it recovers, you already own more of the assets that are now worth more too. It's the same principle big institutions use to smooth out risk. Because the truth is, the biggest danger in a recession isn't losing money on paper, it's losing discipline. When prices swing wildly, emotions take over. And here's where most people go wrong. They stop investing at the exact moment when they should be investing the most. They freeze. And that hesitation, that pause, is what separates the people who stay stuck from the ones who move ahead when stability returns. It might sound familiar, but few people truly apply it when it matters most, because it requires something that can't be automated: trust in the long term. When you stick to a consistent plan during uncertainty, you're not ignoring reality. You're taking control of it. You're saying, I don't need to know exactly when the bottom is, because I'm already building through it. And here's the beautiful part. History shows that some of the best long-term returns come from money invested during recessions, not after them. Because when fear is highest, prices are lowest. And those who can stay steady when everyone else is panicking end up owning the strongest positions once the recovery begins. But there's a catch, and this one's important. Not every investment deserves to be held through a recession. Some companies look solid on the surface, but under pressure, their debt, cash flow, or weak business model starts to crack. So instead of chasing cheap prices, smart investors focus on resilient businesses, the kind that can survive a full economic cycle. These are companies with strong balance sheets, steady cash flow, and products people still need even when budgets tighten. Think utilities, healthcare, consumer staples, the essentials, the kind of companies that keep operating no matter what's happening in the news. But don't worry, you don't have to pick them one by one. Some ETFs hold dozens of these defensive stocks, giving you instant diversification without having to look at every balance sheet. An ETF is simply a bundle of different companies, wrapped into a single investment you can buy just like a stock. And when you combine that with your consistent investing schedule, you've built something powerful, a system that adapts automatically, even in chaos. Now, let's zoom out for a moment. While everyone's focused on surviving the downturn, the smartest investors are preparing for what comes next, because the transition out of a recession is where wealth quietly multiplies. So instead of asking, "Is it safe yet?" ask this: "What can I do today that my future self will thank me for?" Because in every recession, there are two kinds of investors: those who pause out of fear, and those who quietly build their foundation while everyone else hesitates. The truth is, you don't need to predict the future to invest wisely. You just need a clear plan that keeps you calm when everyone else is panicking. And if you don't have that plan yet, don't worry. I put together a free ebook called The Ultimate Investing Guide, and it gives you the exact 5 steps to start investing the right way. You can download it right away through the link in the description, or just go to griffinwise.com. It's the exact structure thousands of investors use to go from feeling unsure to finally investing with confidence. Waiting for the perfect moment might feel safe, but in investing, waiting is the most expensive decision you can make. So take the first step now. Download the guide and let time start working for you instead of against you.